Today, we're diving into a really fascinating story of corporate transformation. We're talking about how an old-school chemical giant, Gujarat Fluorochemicals, is making a massive, multi-billion rupee bet on the electric vehicle revolution. Let's break it down.
So this is the big question, isn't it? GFL is part of the Inox GFL group, which has been around for 90 years. They've got this stable, really profitable business. So why on earth would they risk it all to jump into the super competitive, fast-moving world of EVs? That's exactly what we're going to unpack. All right, so to understand the bet, you first have to understand the powerhouse that's making it. You see, long before EVs were even on the radar, GFL was already a champion in its own right in the world of fluoropolymers. So what in the world is a fluoropolymer? Well, think of it as a kind of super material. It's the magic stuff that makes the coating on your nonstick frying pan, but it's also absolutely critical inside semiconductors, aerospace parts, and yep, you guessed it, the lithium-ion batteries that power electric cars. It's basically a foundational building block for a ton of modern tech. Now, how did GFL get to be such a big deal in this space? They built an incredible competitive moat around their business. For starters, they're the only fully integrated producer in India. That means they do everything, from digging the raw material out of their own mine in Morocco all the way to the finished product. This alone gives them a huge 40% cost advantage. Throw in over 30 years of know-how and approvals in really tough industries like aerospace, and you've got a business that is incredibly hard to compete with. So with a core business that's strong, why change a thing? Well, that brings us to Act 2, the all-in bet. GFL is using its fortress-like position to make a really dramatic pivot. The new game plan is crystal clear. GFL is shifting to make stuff like electrolyte salts and cathode components. We're talking about the very heart of a battery, the things that determine its performance. And right now, India has almost zero domestic supply for these things. GFL is trying to become an absolutely essential part of the EV ecosystem. And believe me, they are putting some serious money where their mouth is. In the fiscal year 2025 alone, their spending on new projects hit 1,125 crores. To be clear, this isn't some small side project. It's a massive, company-defining investment. And it's not slowing down, it's actually speeding up. The plan for fiscal year 26 is even higher, at 1,600 crores. So what does this kind of ambition actually cost? Well, the cash flow statement tells the whole story. And this chart right here just illustrates it perfectly. You can see the core business is still churning out healthy cash, over 500 crores. But the company is spending more than double that amount on new factories and equipment for the EV business. This negative cash flow, well, that's the price of admission to the global EV race. Of course, a bet this big is never without risk. Spending this much cash is bound to raise some red flags, and it's something any investor needs to watch very, very carefully. So let's look at the big ones. First, inventory is sky high, at 487 days. That means a lot of cash is tied up in products just sitting on a shelf. Second, there's this thing called a contingent liability linked to another group company, which is a potential financial obligation you got to keep an eye on. And finally, the stock's valuation. It's already priced for perfection. At these levels, there is practically no room for error. This all leads to a really critical question. Is the company financially healthy enough to actually survive this massive bet? To figure that out, we can look at a few standard financial health scores. First up, we've got the Strategic F score, which is like a report card for a company's fundamental strength. GFL gets a 7 out of 9. Anything over a 6 is considered strong, so this tells us we're looking at solid profitability, a healthy balance sheet, and pretty good operational efficiency. Next up, the Altman Z score. This one is all about measuring bankruptcy risk. GFL scores at 3.85, putting it deep inside the safe zone. So despite all the heavy spending, this score tells us the company is on very stable financial ground. And finally, we have the Benish M score, which is a screen for any signs of earnings manipulation. You know, cooking the books. A score of -2.72 is great news. It suggests that the profits the company is reporting are high quality and reliable. So the foundation looks really solid. Okay, so what do we got? A massive opportunity, some pretty significant execution risks, but a company that is fundamentally strong. So how does this all balance out? Let's take a look at the potential outcomes. This table lays it all out pretty clearly. In a bear case, if the EV project hits major delays or fails, the stock could take a hit. The base case assumes they just keep executing steadily. But in the bull case, where the EV plan is a home run, well, there's some pretty significant upside potential.
It all comes down to execution.
So, after tying all of this together, the strengths, the risks, the valuation, and crunching it into a single number, the final investment score comes out to a solid 64 out of 100.
And this quote from the source report just sums it all up perfectly. The analysis sees GFL as a high-quality company that can grow steadily over time, and it's currently available at a reasonable price, but with this massive, exciting growth story attached to it.
Okay, before we wrap up, here's a quick but really important disclaimer. The analysis I've shared here is just for educational and informational purposes. I want to be super clear. I am not a SEBI-registered research analyst or investment advisor.
You've got to remember that investing in the stock market comes with significant risks. All the data and charts you saw are based on public information and my own research notes. So please, don't treat any of this as a buy or sell recommendation. You should always do your own research or talk to a CBI-registered professional before making any financial decisions. If you found this deep dive helpful and you want to stay updated with more stress-free investing analysis like this, please do me a favor and hit that subscribe button. And don't forget to press the bell icon so you never miss an update. Now I really want to hear from you. Which Indian-listed company should I break down next? Drop the stock name in the comments below, and who knows, it might just be the star of our next explainer.
Thank you so much for watching, and as always, keep your investing stress-free.